Good day, fellow investors. Here a great comment how the markets are efficient, how it doesn't pay to be an active investor, how you can't beat the market no matter how much you try. Buffett didn't do it for the last 30 years. 90% of managers don't do it. And then there was just answer here how Buffett size, things like that. And then another rebuttal here. So almost 90% of professionals, no amount of research or hard work, value strongly underperformed the market because it looked cheap, because it did well in the past, now it doesn't make sense. So I want to touch on these topics and give my opinion. I think I never discussed the efficient market hypothesis because it is counter value investing, but after such a strong comment, I feel the time is now. Then there was this also great comment in relation, diversification, more concentration, and also something very important here. Like you, I have observed that there have been great stretches in the market where stocks go nowhere. 29, 54, 68, 82, 2000, 2013. So despite what everyone says, timing the market and missing a big sell-off can be very profitable. Okay, that's another way of looking at things. But then again, do we have to beat the market or do we just have to reach our financial goals? There's a big difference there. So let's start. With this moment here, if you continue here and you take the red pill, your life will not be the same as it was before you listen to someone, let's say, talk differently than what's the predominant mantra on financial markets. I think that 2% of the market looks at investing and things like that like we do, while the 98% will keep praising the flat earth society. Warren Buffett's words. Be very careful. If you know, if you're efficient market, SP 500, making money on all these things, good luck, I wish you all the best. If you are still here, let's start discussing things. 90% of professionals don't beat the market. Okay, the market is made of professionals, so 50% should not beat it, 50% should do better. Add the fees, that's already, on average, professionals will underperform the market. Add the clients' expectations, the withdrawals, the fact that you lose your job if you underperform for 3 years, then it is clear why that doesn't happen. And then again, we'll discuss also what market. So let's start with 90% don't beat the market. My goal should then be to be in the 10%. So my mind goes like this. What do I have to do to be in the 10% of money managers? Then I constantly beat the market because 10% of people do it. Let's be blunt here. Why would I be like the rest of the population? I work hard, I get up at 4 in the morning, I work till night, I have a Ph.D, I have 20 years of education, 15 years of experience. I work my ass off. Why would I expect anything to be like the rest of the population? Let's be clear here. Good luck with your averages, I'll stick to my focus. Professional investors, let's go to the Big Short. Michael Burry says everyone can see that there's a real estate bubble. And then the answer from the investor is actually no one can, only you. If you manage money professionally, you manage it again for a client. Is the client rational? Very, very difficult to find rational clients. When I discuss asset management opportunities with clients, I found one person that's rational. All the others that have money are complete irrational personalities, and therefore I don't accept their money for management. When things get hard in investing, you need to have the right mindset. That's where the difference is made. With management, yearly measures, performance, constant, if you underperform, everyone switches away. No amount of research will give you any advantage about the businesses because everything is already priced in. I never tried to beat the market. I don't go out and try to beat the market. I don't give a rat's ass about the market. What I want to do is find investments that fit my investment requirements, that might lead me to my financial goals. Whatever the market does, who cares? And this makes me biased because I've been investing for 23 years now. And just quickly, so I started here 2002, 2025. The market did very well, the S&P 500. I did my 5x in the first few years. Then I lost 20% in the crisis, which means from the start I was at the 4x. 2010, 2016 I did another 4x, that's 16x. Then since I launched, let's say take a pause here, I made some money but I don't know exactly how much. Then I launched my research platform and model portfolio. I did 15% per year, 2.5x. And if you want to check my performance, I am at par with the market with a lot of work. That's correct. Should I stop doing and just invest in the market? We'll discuss that. But all in all, since I started, 16x times 2.5 is 40x my money. Let's compare it to the market. If I include the dividends there, that is an 11x. So I did much better without the market. This is why I'm biased. If I had invested in the market, I would not have the money to increase my circle of competence in 2009 and go do a PhD. I paid for it. 2014, I left my job. I had the money, thanks to investing, to go to Bloomberg, to go to London, to lose 20,000 in 10 months on rents. We didn't want to live in rooms, so we rented an apartment in London, other education on top of it. That is what investing allowed me. If I was just focused on the market, I would still be a poor teacher in Croatia. That's the story of my life. It's just different for different people, likely. And then another thing, I like investing the way I invest. My portfolio PE ratio now is 10, has been over the last 7 years, and I've done equally as the market. The point is that what I try to do is real investing versus whatever efficient markets do. Because when this time comes that the market does nothing, then real investing shines. If I do my 15% against the 15% of the market, when the market does 15%, okay, I don't expect to outperform in good markets. And keep in mind that markets have cycles. We are now in a great market cycle for the last 15 years. No recessions, everything is great. We print money, we lower interest rates, financial assets go up. Everyone is a genius. Let's go back here. Keep in mind the market was down 60%, I was up 4x in the first 10 years. I would not have had the money to invest in my PhD here if I had been down 60%. Also, likely not investing here because it looked terrible. And that's the story of my life. Here again, 30 years of nothing, 15 years of nothing, down 60% in real terms. So here is where investing shines. And here is where, yes, it is stupid to do your job, Sven. Sven, you're an idiot. Sven, look at how much money we are making on Palantir, on things like that. However, I also look at history, and each time when we were at these valuations, each time this happened. Whatever here happens, I don't want to be part of it. Because if we speak of outperforming, in the next 10 years, if the market is down 50%, and your investment manager or your somebody is down just 40%, that would be the genius of the next 10 decades. So, oh, you lost me just 40%, thank you, you are a genius. Does it work like that? Would you call your investment banker, let's say you have 100 million, everybody lost 50 million, he lost you just 40 million. Would you call him and say, thank you for losing me just 40 million? To stay in the movie, If you lose me just 40% while the market loses 50%, I will personally give you a will you call your investment banker and do that? Do I have to even discuss this? But as we said at the beginning of the video, you have taken the red pill here. Let's continue. Because despite this great market that we are living here and everyone is watching here, where are these guys? Think how you felt here. 53% down in 9 years, after 9 years with minimal dividends. The dividend here was 1% like it is now 1%. And then, speaking of Warren Buffett, 1984 article, The Super Investors of Graham and Doddsville. Keep in mind, 1968, 1984, the market did nothing. You can download it here in my free stock market investing course in the link in the description below. He discusses how the academic world, if anything, has actually backed away from the teaching of value investing over the last 30 years. It's likely continue that way. Ships will sail around the world, but the flat earth society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. So we'll just keep on doing our Graham and Dodd and keep prospering. Another 85 letter to shareholders. We are enormously indebted to those academics. What could be more advantageous in an intellectual contest, whether it is bridge, chess or stock selection, than to have opponents who have been taught that thinking is a waste of energy? And speaking of outperforming, the S&P 500 is 100% invested. This guy has 30% of assets, 50% of equity in cash, and he's still performing. And people compare anything performing with 10% of the risk, 20% of the risk. It's about the risk and reward. Efficient market thesis, hypothesis completely disregards risks because it's already priced in. Risks don't exist, but we'll get to that too. Now, research gives no advantage. Okay, if I had to pick 2 stocks that will beat the market in the next 12 months, no way, it's just a gamble. So I cannot do that. Therefore, yes, in the next 12 months, research gives no advantage. If I have to pick 2 stocks that will deliver good returns no matter what happens over the next 5 to 10 years, wait for them to come to the right price in the next few years to buy the right business, that's something different. And yes, research doesn't give any advantage in this market. I mean, if you research this, then you can say, okay, it's impossible to research, and now look at the price, it's just going up, it's crazy. Tesla has a market cap of 1.4 trillion. The total cumulative profits in the last 15 years was 25 billion. This is all the money Tesla made. So yes, it doesn't make sense to make any research. However, if this ever happens again, here it will pay to do a lot of research. I'm not predicting, we will see what will happen. I don't care what will happen. I'll just keep doing it that whatever happens, I do well. Maybe history will rhyme, maybe this time it's really different and stocks keep going up 1% a day. But okay, stocks keep going up 15% per year. If I keep doing my 15% my way, like I've done in the last 7 years on my research platform with my model portfolio, fine by me. And now we discuss academia doesn't understand investing risk. They don't care about risk because everything is priced, you cannot know, who cares? Again, risk, Buffett in cash. P/E ratio of S&P 500, 31. Mine is 10. Growth equal, I don't know, 5% earnings for S&P 500, 6 to 10 for mine. So fundamentally, I'm doing better. Risk is not volatility. They see a price go up and down. Ooh! Risk is a margin of safety. I don't care where the price goes. If I can't lose money from a fundamental perspective over the next 5 to 10 years, there is a margin of safety, and that is good enough for me. Whether your goes up or down or doesn't ever get up or who, I don't care. So markets are extremely efficient. I completely agree, at totally disregarding risk. And then even passive becomes active when passive doesn't work. French bonds, news from 5 days ago, risk of forced sales if credit score is cut. And then what do the masters of efficient market theory do? They redraw the rules to keep French bonds, because if they would have to sell, it would destroy the liquidity in the market, and the market would not, and there would go down, and that would look simply ugly. So let's redraw the rules. Let's go, oh, here we are passive investors, efficient market, and here we become active because, oops, our thing doesn't work. And efficient market theory works until it doesn't. Long-term capital management, it worked until it doesn't. And when it doesn't work, when reality hits the efficient market academic theory. And let me again tell you, Sven, you're wrong. French bonds are perfectly priced. There is absolutely no risk. I completely agree. With a 4% yield, 10, 20 years from now, there is a guarantee. There is no risk. There is a guarantee. You will lose your purchasing power by investing in French bonds. But then again, markets are efficient. Put in bonds, put in this. Who cares? And we discussed this, how BlackRock is just investing everywhere, don't care about the price. Yes, they've done well. Unfortunately, the true investors that are warning about that, like Icahn did a few years ago, we'll see those discrepancies are old and almost dead. But that's the story. And now BlackRock keep ramping up private bets, insurers putting more money, and it is just a flow of funds where everything goes up, and then even they are less risk, lower volatility because there is no market that's priced the thing. So, oh, the market went down, my assets go up in price. That's private equity pricing. So there is a lot that tells me risks are accumulating. I hope, again, the risks don't materialize because it would lead to so much pain. But given the exuberance and everything keeps going up, it might last another 10 years. I hope so. But if this reverts, then again, this will be the major problem in some period in the next 10, 20 years. The fact that everything is priced in and the risks are not there or completely disregarded. Because nobody can tell me that there is the same risk of investing in the S&P 500 at, I don't know, 900 points, 2,000, 3,000 or 7,000. Nobody can tell me the same risk. Risk is a function of price compared to fundamentals. What can go wrong? Academics look at it as volatility. To each his own. And thankfully for that, everybody stays with academics. And as Buffett says here 40 years ago, I have seen no trend toward value investing. In the 35 years he practiced that before it. So now with the markets booming, again, no trend. But let's also discuss Buffett's performance. You go to whatever letter, last letter, you see this. Buffett did 20% over 50 years, the S&P 500 did 10.4. And people still dare to discuss about Buffett's performance. And then you say, oh, he does insurance, he does this, he does that. And that's the difference between the academic version of value investing, low price to book, low PE, and real value investing. Real value investors go where the freaking value is. So if the value is in insurance, you go there. If the value is in gold or copper or mining, you go there. Where the value is, that's where you get your returns. You just have to understand the short-term orientation of the efficient market hypothesis. Yes, or the short-term information is priced in. 2 years, 3 years, 5 years, the cycles totally wrongly priced. No, at least not priced in. And that is where you have an advantage. Then again, over the last 30 years, I don't know what you're talking about. Berkshire did 25x. The market did 19x with dividends. But again, Buffett did beat the market, didn't beat, it's completely irrelevant. It's about the way you compound your wealth and reach your goals. The way, not the performance. You might get lucky and the markets get lucky and they perform. But what when luck reverts? Now everything is AI, everything is going up. Okay, Buffett is managing risk first, which is the core of value investing decision. Efficient market hypothesis completely disregard risk. And then again, academia sees value as book to market, earnings yield, cash flow yield. Value is not low PE, low price to book. Value is margin of safety. I cannot lose. And then you compare it with the upside. Doesn't mean price to book or P ratio. Yesterday we discussed Comcast, P ratio 5. Is it value? I don't own it. Now, when it comes to can I beat the market, why don't I say, do I have to beat the market? And before that, what market? Yes, you look at the S&P 500 over the last 30 years, great 20x. You look at the global MSCI index, what's that? That's a 6x, great. But then again, it's mostly made of the S&P 500 because it's 65% of the global weight. Let's look at the Nikkei over the last, what's this, almost 40 years. Zero performance. Let's look at the Dutch index, up what? All time 65% over 25 years. That's terrible. What market do I have to beat? Do we know the performance of the S&P 500 over the next 20 years? Looking at history, it will be 0 or less than 0. You do whatever you want. What strategy do I have to beat? 60-40, crypto, AI, whatever. To me, it's not about beating whatever. I will always get beaten by somebody. To me, it's about performing. The risk I can accept and the reward I can get. And that's what I'm looking for. I'm not trying to outperform anyone. I don't care about the market. I'm trying to build an investment strategy that works for me. My goal is to maximize the level of wealth with no risk that I can achieve over time. Or the lower bound of wealth as Mark Spitznagel would define it. Because we have no idea what will happen next. Will this happen, 60% real returns down in the next 10 years, or this market will be again a 3x in the next 10 years? Both are possible, but I want to maximize the lower bound of my wealth no matter what happens. Maximize the minimum plausible wealth, ensuring that even in extreme market conditions, the investor downside is limited. The last 100 years, there were 3 extreme market conditions, not to mention the 1987 crash between 1974, 2009 crash and things like that. That can also be called in between. But whether we'll have an extreme situation or not, I want to maximize my wealth no matter what happens. And then, if the S&P 500 does 20% per year by 2035, and I do my 18% per year, and underperform the market, and get all these comments when you underperformed, I'm fine with that. Where do I sign immediately? My business, P ratio 7, growing at 20% per year, return on equity last 12 months, 30%. I'm buying it at 70% of book value, so I should be 21, still beat the market with 21%. Let's say something bad happens and I do just 15%. No matter what the markets do, I'm okay with that. I'll stick to being in 2% of the population that disregard the efficient market hypothesis. I've been doing it for 25 years, it comes natural to me, and I'll just keep on doing it. We'll just keep on doing, enjoying life, compounding the way we like to compound. Efficient market theory, S&P 500, passive investors. I wish you all the best from the bottom of my heart. I don't wish for a crash. I don't wish for 10 bad years, because even if I would make a lot of money and value investing would revival and blah, 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 because of the sheer destruction that it will lead to humanity with populism and this, I hope to keep on being the idiot on YouTube that sticks to value, that does the boring thing. I hope with the whole of my heart to keep on doing that. So this is my view of the efficient market hypothesis. Thanks, and I'll see you in the next video.